Predicting outcomes of complicated issues like elections or legislative changes is more often than not futile, but that doesn't mean that you should disregard them entirely. Analyzing what you know and thinking objectively about how certain scenarios may impact your future can be an incredibly valuable exercise for making informed or more informed financial decisions. In this video, I'll compare the potential impacts of two scenarios on retirees. Scenario 1, where the current Tax Cuts and Jobs Act sunsets in 2025, causing tax laws to revert to pre-2018 rules, and Scenario 2, where the Tax Cuts and Jobs Act is extended and made permanent. Alright, so before I dive in, I just want to make it clear that I didn't create this video to offer my opinion or to take a stance on how the nation should be taxed, and although I am a certified financial planner and a chartered financial analyst, I'm not an accountant, so I'm certainly familiar with tax and legal issues in the context of financial planning, but you should always consult with your tax advisor or your attorney when you're making complicated decisions. I'm simply hoping to offer pre-retirees and retirees objective insight to how their tax situation may change and how to incorporate this new insight into their financial decision-making process. So there are two broad concepts to understand when it comes to the taxes that you pay as a household. Number one, the marginal tax tables for calculating your federal income taxes, and number two, your taxable income. Your taxable income is essentially the final income number that's run through the marginal tax tables, and the marginal tax tables determine how much of that income is taxed and at which percentage. Both of these concepts will be different under each scenario, so let's talk about the marginal tax rate first. Alright, so if you're not familiar with how federal income taxes work, your income is taxed on a sliding scale, so it's not taxed retroactively. So the first chunk of your income will be taxed at the first marginal rate, the next portion will be taxed at the next marginal rate, and so on. So in other words, if your income exceeds a marginal tax rate, only the income above that rate will pay taxes at the higher rate, not the income below. So let's compare today's marginal tax table with the 2017 marginal tax table adjusted for inflation. If you're wondering how I came up with these numbers, I simply calculated the actual percentage increase for each bracket that we've had year over year since 2018, and then I applied the same percentage increase to the pre-2018 brackets. I did the same thing for standard deductions, which we'll get to in a bit. Alright, so anyway, the yellow highlighted rows are where I find the majority of retirees tend to fall. And as you can see, the income levels for these brackets under either table are very similar. So the key difference is in the tax rate, which is marginally higher for the 2017 adjusted brackets by about 3%. So the net impact for retirees, if the current tax code sunsets and reverts to the pre-2018 rules, is a slightly higher percentage tax that's assessed on their taxable income. So for example, other things being equal, if the tax laws are to revert back to the way that they were, distributions from IRAs, taxable interest that's earned on bonds, part of your Social Security benefits, and so on, may be taxed by about 3% more than if not. Alright, so moving on to how either scenario may affect your taxable income portion of this equation. This is also important because your taxable income is the actual number which runs through these tables. So the higher your taxable income, the higher your tax, other things being equal. Your taxable income is solved for by taking your before tax income, subtracting your above the line deductions, which are just a fancy term for your deductions that you can use to reduce your taxable income without having to itemize in your tax returns. A common example of this would be money that you put into a 401k before taxes or to a health savings account, an HSA. Once you subtract your above the line deductions, you can then subtract your below the line deductions. This is a big one for comparing these two scenarios. So a big change that occurred when the tax laws changed back in 2018 was that the standard deduction was doubled. The standard deduction is what you'd use to reduce your taxable income if you didn't have those itemized deductions like mortgage interest or property taxes. But although the standard deduction was doubled, many of these itemized deductions were seriously limited. But before I get into the details of these specific deductions, let's do a quick summary related to taxable income. So again, to arrive at your taxable income, you begin with your before tax income, you subtract your above the line deductions like 401k and HSA contributions, and then you subtract either the standard deduction or your itemized deductions, whichever of the two is higher. The current tax code has a much higher standard deduction at around $28,800 compared to the 2017 adjusted deduction of roughly $15,675. But the old tax law that's currently set to come back starting in 2026 also allowed for more itemized deductions, making it more likely that people would itemize their taxes. So the question is, would you have more in itemized deductions than $28,800 under the old tax code? If you don't or won't, then your taxable income will be higher, meaning more income is subject to federal income tax. If you do or will, your taxable income would be lower, meaning less income will be subject to federal income tax. Here are some of the common ones. Under the current tax law, you can deduct up to $10,000 of your state and local income and property taxes. In the old law, this amount was uncapped, so this is probably the big one for retirees, especially with the property taxes. Another big one is mortgage interest. Under the current tax law, you can deduct mortgage interest on new loans taken after December 15, 2017 on debt up to $750,000. Under the old law, this would otherwise be $1 million. Although many retirees aim to pay down their debts before retirement, it still may be applicable for many of you. Also, under the current tax law, you can deduct interest on new home equity loans taken after December 15, 2017 if they were taken to buy, build, or substantially improve the home in question. Under the old law, the use of these proceeds was less strict, meaning that you could generally deduct interest on home equity loans up to $100,000 if you were married or $50,000 if you were single. And you could do this for really any purpose. Another common one is under the current tax law, you can't write off miscellaneous expenses. Under the previous tax law, you could. These are things like unreimbursed employment expenses or professional fees. So the crux of the issue as it relates to this is that you may have higher or lower income that's subject to federal income taxes in 2026. If the tax law sunsets as it's currently set to, your taxable income will be higher if your itemized deductions are less than roughly $29,000 measured in 2024 dollars, and alternatively, if you have high deductions that have been capped maybe under the current tax law, your taxable income may be lower. Let's use some real-world examples to illustrate this. All right, so let's assume a retired couple in 2024 has $60,000 in Social Security income that's subject to taxes. Let's assume that they typically withdraw $50,000 from their before-tax retirement account each year. They have no other income and they have itemized deductions of roughly $20,000. Since the $20,000 is lower than today's standard deduction, they'd use the standard deduction, which creates a taxable income of roughly $81,200. We run that number through the tax tables today. They'd pay 10% tax on the first $23,000 roughly, which amounts to $2,300, and then they'd pay a 12% tax on the remaining $58,000, which amounts to roughly $6,900. So there'd be a total tax of roughly $9,200 for an effective federal tax rate on their total income of roughly 8.4%. Now let's assume that the tax law reverted last year, just to argue this, and we were under the previous tax laws before 2018. Let's assume that they have high property taxes, so their itemized deductions under the old tax code are roughly $25,000. In this case, they'd likely itemize, which would create a slightly higher taxable income of roughly $85,000. We run that through the hypothetical adjusted tax table today, and they'd pay roughly 10% tax on their first $23,000 of income, which amounts to roughly $2,300 in taxes, and a 15% tax on the remaining $62,000 or thereabouts in income, which amounts to roughly $9,200. So under this scenario, their total tax under the hypothetical adjusted tax law would be roughly $11,580 for an effective federal tax rate of 10.5% on their total income. So this person would pay roughly 2% more in federal income taxes on their income. All right, so now let's use another example. Assume that a retired couple in 2024 has $60,000 in Social Security income that's subject to tax. Let's assume that they typically withdraw $100,000 from their before-tax retirement account and have roughly $20,000 in taxable interest from their bond investments. Let's assume that they own several houses and pay a significant sum of money in property taxes each year. But due to the cap deduction under the current tax law, they're only able to itemize roughly $30,000 on their tax return. So in this case, their taxable income is roughly $150,000. We run that through the tax table today. They pay a 10% tax on the first $23,000, which which roughly amounts to $2,300, and a 12% tax on the next $71,000, which amounts to roughly $8,500 in taxes, and then finally a 22% tax on the rest of the income for a tax of $12,254. So there'd be a total tax in this case for federal income taxes of roughly $23,000 for an effective federal tax of roughly 12.8% on their total income. All right, so now let's assume that the tax law reverted last year. Again, to argue this, we were under the previous tax laws before 2018. In this case, let's assume that their itemized deductions are greater because of the uncapped deduction on their property taxes, and they're able to itemize, let's just say $50,000 instead of $30,000. So they now have $20,000 less in income that's subject to federal tax. We run that through the hypothetical adjusted tax table today. They pay, again, that 10% tax on the first $23,000, which amounts to roughly $2,300 in taxes. They pay 15% in taxes on the next $71,000, which amounts to roughly $10,700, and then finally they pay a 25% tax on the remaining income for an amount of roughly $8,873 in taxes. So in this case, their total tax under the hypothetical adjusted tax law would be roughly $21,880 for an effective tax rate for federal income taxes of 12% on their total income. So this person would pay roughly 1% less in federal income taxes on their money under the scenario where the tax law were to sunset, which it's currently projected to do so. And again, I just want to reiterate that I'm not showing you these examples to prove to you that one way of taxation is fairer or better for our country, but rather to show you that it's really going to depend on your situation. But in any case, I do believe that the magnitude of change is going to be marginal or small for the average retiree. So if you have few deductions and lower income, you may pay something like 1 or 2% more in average income taxes should the tax laws revert. And alternatively, if you have higher itemized deductions, then your effective tax rate may fall a bit. In terms of planning around these scenarios, the main thing that I would suggest to do is just to consider how potentially paying slightly more in taxes might impact your money over the long run. Of course, paying 1 or 2% more in taxes isn't much, but over a 30-year period, the compounding of this can certainly have its impact on your money over the long run. In working with my clients, I model their retirement cash flow under both scenarios, but if you don't have access to something like this, something that can model future taxes on that granular of a level, then I would just simply suggest assuming that you're going to pay slightly more in taxes to ensure that your money can handle the incremental stress or the extra stress. In summary, the tax code is set to change beginning in 2026. This is a highly complicated topic that's far deeper than the topics that I've covered, but I think the takeaway for retirees is that the amount of federal income taxes that you may pay as a percentage of your total income may rise or fall, but it's unlikely to be by a substantial amount, other things being equal. If you feel that you'd benefit from a second set of eyes in your financial situation, or you just simply want to know where you stand, then please feel free to click the link in the description of this video. It'll bring you to my calendar and you can set up a complimentary call with me. I wish you the very best of luck, and I hope to hear from you soon.